Did you know that 84% of professional money managers fail to beat the market over a 5-year period? This startling fact raises the question, why do so many people still try to pick individual stocks? Imagine if your hard-earned money could work smarter for you. This is what the debate between stocks and index funds is all about. In this video, we'll explore this age-old financial dilemma, presenting not just statistics, but real-life examples to illuminate both strategies. By examining the data and following these stories, you'll gain insights to help shape your own financial future. Let's dive into which investment approach might be best for your goals. Meet Sarah, a 28-year-old software engineer with a passion for researching companies. She's always been fascinated by the stock market and believes she has what it takes to beat the average returns. With $10,000 saved up, Sarah decides to dive headfirst into the world of individual stock picking. Sarah's approach is methodical and time-consuming. She spends evenings deciphering quarterly reports and crunching numbers on Excel, her weekends consumed by deep dives into potential investment opportunities. This level of dedication is common among individual stock pickers, who often dedicate 10-20 hours per week to research and portfolio management. Initially, Sarah's hard work seems to pay off. She identifies a few promising tech startups and invests heavily in their stocks. To her delight, these picks perform exceptionally well in the first year, doubling her initial investment to $20,000. Sarah's confidence soars with this early success. However, the stock market is notoriously unpredictable, and Sarah soon learns this firsthand. In her second year of investing, one of her major holdings experiences a significant setback due to a product recall. The stock price plummets, wiping out a large portion of her gains. Sarah finds herself on an emotional roller coaster, experiencing highs when her picks perform well and lows when they underperform. This volatility is not uncommon in the world of individual stock picking. Studies have shown that the average retail investor underperforms the market by about 1.5% per year. Furthermore, only about 10% of active stock pickers manage to consistently beat the market over a 15-year period. Despite these challenges, Sarah remains committed to her strategy. She continues to research and adjust her portfolio, learning from her mistakes and refining her approach. After 5 years of dedicated effort, Sarah's portfolio has grown to $18,000. This represents an average annual return of about 12.5%. Beating the S&P 500's average return of 10.5% over the same period. While Sarah's 2% outperformance of the market might seem like a victory, it's important to consider the time and effort she invested to achieve this result. The countless hours spent researching, analyzing, and managing her portfolio come at a significant opportunity cost. Additionally, the stress and emotional toll of riding the market's ups and downs can be substantial. As Sarah rides the roller coaster of individual stock picking across town, a different investor takes a drastically different approach. Meet Mike, a 30-year-old teacher who seeks a more balanced lifestyle through passive investing. Like Sarah, Mike has $10,000 saved up for investing, but that's where the similarities end. Mike decides to invest his entire $10,000 in a low-cost S&P 500 index fund. His goal is steady, long-term growth without the stress of constantly monitoring the market. He sets up an automatic monthly transfer of $200 from his bank account to his index fund, demonstrating the importance of regular contributions in maximizing compound growth over time. Investing in an index fund is like owning a slice of every pie in a bakery, rather than betting on one flavor to win the day. An index fund tracks the performance of a specific market index, such as the S&P 500, providing broad market exposure and diversification. Index funds operate like a well-oiled machine that runs steadily in the background. Their passive management style eliminates the need for constant monitoring, allowing investors like Mike to maintain a calm demeanor during market fluctuations. This emotional stability helps prevent impulsive decisions based on short-term market movements. Studies show that during bull markets, index funds tend to outperform active stock picking. When the overall market is rising, it's challenging for individual investors to consistently pick stocks that outperform the broader index. During bear markets, active management can sometimes outperform index funds, But this is less common given that the stock market has historically trended upward over long periods. As the years pass, the contrast between Mike and Sarah's approaches becomes more apparent. While Sarah experiences the emotional highs and lows of stock picking, Mike remains remarkably calm during market turbulence. This aligns with broader market data, which shows that index funds generally outperform most active investors over time. As we approach the 5-year mark of their investment journeys, the results are revealing. After 5 years, Mike's portfolio has grown to $20,500, slightly outperforming Sarah's $18,000. This outcome demonstrates the potential benefits of a passive, long-term investment strategy. As Mike and Sarah's investment journeys enter their second half, a looming crisis threatens to reshape their financial futures. The stock market, once a beacon of growth, faces its greatest challenge in years. Their divergent strategies will be stress-tested in the coming market downturn, setting the stakes high for both investors. Before the crisis hits, it's worth recalling the emotional toll and time commitment Sarah has invested in her stock-picking strategy, contrasting with Mike's more hands-off approach. These factors will play a crucial role in the upcoming challenges. In the 7th year, a major market downturn strikes, sending shockwaves through both portfolios. Sarah's carefully selected stocks plummet, some by 40% or more. The S&P 500, which Mike's index fund tracks, also declines sharply, but his diversification cushions the blow. As the market spirals downward, Sarah faces a crossroads. Her once promising stocks now underperform, tempting her to sell and cut losses. Anxiety grips her, manifesting in numerous sleepless nights spent analyzing financial reports. In contrast, Mike's approach remains steady. His broad market exposure means he's not overly vulnerable to any single company's misfortunes, allowing him to maintain a more even emotional state. The downturn persists for several months, aligning with historical data showing bear markets typically last around 10 months. During this time, Sarah's portfolio experiences volatility reminiscent of the 2008 to 2009 financial crisis, when the S&P 500 declined by 57%. As recovery begins, both portfolios rebound. However, this phase reveals another advantage of Mike's approach. His diversified holdings benefit from broad market gains, mirroring the pattern after the 2008 downturn when the S&P 500 index fund rebounded, with an average annual return of 12.5% over the subsequent decade. Sarah's recovery is more uneven. Some stocks bounce back strongly, while others lag. This disparity highlights the challenges of consistently picking winning stocks long-term. Moreover, the impact of fees and taxes on Sarah's returns becomes increasingly apparent during the recovery. Her frequent trading incurs transaction costs and potential capital gains taxes, eroding her overall returns. Mike's low-cost index fund, with its 0.04% fee, minimizes expenses, allowing more money to remain invested and compound over time. As the 10-year mark approaches, Mike's disciplined approach leads to a portfolio value of $35,000. Sarah's more volatile strategy results in $32,000, illustrating the potential pitfalls of active investing over the long term. Sarah and Mike's approaches each have strengths. Active stock picking offers higher potential returns with increased risk, while index funds provide a hands-off strategy with consistent market performance. Many investors succeed with a blended core and satellite approach, combining both methods. Your ideal investment strategy depends on personal goals, risk tolerance, and lifestyle. Whether you choose active picking, passive investing, or a combination, consistency and discipline are crucial. Consider the data we've explored and reflect on your own preferences. To help you get started, we've prepared a downloadable investment checklist. Use it to assess your risk tolerance and chart your path forward.